Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, June 8th, 2023. It's 4:22 Eastern Time, so the markets are now closed. I have the after-hour trades on, but let me turn those off real quick. There we go. Okay, so this will just show us what happened today. And it'll be a quick video. I did a little bit more extensive one this morning. I just wanted to recap the equity markets plus the FANGs. That's what I didn't cover this morning, big tech. So we'll go through the top half dozen or so, which really make up over half of the entire Nasdaq 100 returns, just a handful of stocks. I'll get to that in one sec. All right, so I fired off a post right at the close. That's the S1. Remember, support once broken becomes resistance. So now I just retest that S1 R1, or just really R1 because it's already been broken. So we had 1-2 tests of that. And that was certainly a more significant resistance level than the one I pointed out earlier today. So just as that was objective right there, that 351-ish level, it was resistance. I'm going to pick that up. You can see once we cleared it, I just rounded it off to 351. I had it at 350.99. And so we took that out. Then we hit there, back tested. So that is also support. We had reactions here. It was very minor, as I mentioned earlier. It was a very minor support. So we went up through there. One reason, I've said this multiple times, but everything I say bears repeating, new folks coming into the site. The one reason, one of several reasons that I will often post both the futures and the ETFs on an index such as QQQ and NQ, the futures, is you want to watch both. Some traders are trading the futures, some are trading the ETFs. So this tag, you can see I had T2 lined up with these reaction lows, which is roughly where I had it on the futures, but you can see when we reversed, because this is regular session. The futures trade round the clock, so you're going to see different reaction points. And so that was the reversal when it was an exact tag at T2 on the futures. I'll get to that in a sec. But so that's it. So far, just to recap, we shorted in anticipation of a breakdown. There's a high probability of it, I figured. And then the breakdown there. Then we danced on S1 for a while. Then we broke it, another objective entry. And that's what we had two back tests, or the second one was a near back test. So that's it. So I would expect we go down now to ultimately down to T3. You could certainly, depending on where your entry, because I list multiple entry points on most trades, you could keep a very tight stop somewhat above S1R1, or if you took the initial entry, that's right there, and now you had a reaction high a little bit below. So far we're in right at the top on the initial entry, and but you had a reaction close enough, so that's resistance as well, so you could have stops there. I will say this right away, that if we do push up and make a marginal new high anytime soon, it has to be soon, the divergences will still be intact, and they'll be even larger. So when you look at it on the 60-minute chart, here's what it looks like. You have the wedge. This is that 15-minute wedge we shorted here. And then you have a more significant longer-term uptrend line with quite a few reactions to help it be validated. Let me give you another tool here. So you have the initial low there back in March, mid-March, a couple more reactions along the way. And that's still the T3, which as of now is the final target. We'll probably get a tradable reaction there if we get down there, but I very well may add additional targets. So that's what it looks like from the 60-minute perspective. Jumping out to the daily time frame, it's what I call my busy board, but if you'll just bear with me, a lot of lines. That means what stands out most important are the divergences that are still in place right there, the negative divergences of prices making higher highs. They've been extending. Yes, I were pointing them out back here. No, they did not play out for anything more than just a consolidation followed by another leg up. But yes, they're still very much intact. And the only difference is they're much larger, therefore indicating the potential for a much larger drop should those divergences remain intact. The other thing that stands out to me when I look at this, if you look at the PPO, you can see the PPO line crossing down pretty sharply. That's the orange line there. poised, but it hasn't yet made a bearish cross of the PPO. I'm sorry, of the signal line, the white line. If that happens, one of two things happen. Now, again, this is just in my book. I don't know if it's written in any textbooks, but I always say divergence is potential when you have a security or the indicators making lower highs against prices making higher highs. That's potential, and it's confirmed when you get that bullish crossover, because to me that effectively puts in a lower peak, lower than the previous peak there. Once the bullish crossovers, because these are momentum indicators. So momentum right now is up. Just because a PPO line has turned down doesn't mean that it's going to make a bearish crossover. We could continue up, and then sooner or later there's no more divergence. Again, this is one index. It's not the entire market. We still have it on SPY and others, and still will if we make a marginal new high here. But I just want to point that out, that it will be confirmed in my book. And the other thing to that is, let me pull it back down. I'll put up the old PPO histogram. That's the PPO right there. Histogram shows when the two lines cross. Let me flatten this down. And you can see right here, let me scrunch this one down for you, RSI, PPO, and show you that it's a decent, not an infallible, but a decent trend indicator, or buy and sell signals. So what you look for are these hills. In other words, they're green when the PPO line is above the signal line. When it crosses to red, like right here, here, and here, those are the bearish crossovers. So I'm going to just extend these lines up and just show you what happened when we got the bearish crossovers. And again, this one appears imminent. You can see the PPO has already rolled over. Doesn't guarantee a cross. Sometimes you look like you're going to cross and you either get a whipsaw like this, or sometimes it'll start rolling down and then pick back up. However, when it crosses, I'm just going to show you, so for the record, bearish crossover there. That did not result. It did result in a correction, and it was tradable. That was single digits. I'm just eyeballing it, probably 4 or 5%, but it was certainly at least a correction. The market, the Qs stopped going up and they went down and sideways for a while, right? You can, again, like I said, it's not a perfect sell signal, but that one was certainly a tradable correction right there. This one, certainly a tradable correction to follow. That was certainly a whipsaw right there, because we went green right after. We had one right there, and that was one of the biggest drops of the bear market. We had another one right there, pretty big swift drop. One right there, that was a massive short trigger. And you can see a couple whipsaws early on, but right when the bear market began, when the Nasdaq topped, we had one there as well. So again, you would have been shaken out by a few of those whipsaws to the upside. So a pretty reliable indicator. And again, these are momentum indicators. This is not rocket science. It shows that a strong trend is losing momentum. And when you get the bearish crossover, that in itself could be taken as a sell signal. I like to use that in conjunction with other things, such as the sell signal on the bearish rising wedge breakdown that we just had. The other thing, when I look at the daily chart, let's see here. Let me turn the lines back off. Let's go back to and look at a comparable run. So right here, you had this period of consolidation. That was the last big correction right there. And if you follow the pop-up box to the left, that was about a 24% run. And that and takes us to where we're at today. If I go back to, it is August right here, we had at that point, you can see the pop-up box to the left, it's on the bottom. That was also exactly rounded off a 24% run, again, from this reaction low to that high. So this was a correction. Again, this to that's 24%, that. So it's not a set number, but there is a certain point where, and it's incremental, and it's pretty rapid when you hit that point where profit taking occurs. You're going to get these runs, even if you want to say this is a new bull market, we're going to new highs, there's going to be profit taking. I think even the most bullish bulls believe that hey, we're at least due for some profit taking. So that's lining up with the sell signal we just got the other day on the bearish rising wedge break. It's also lining up with the PPO bearish crossover, which is pending. The divergences tell me it could be much more. It could be another significant drop like this one or more. But I wanted to point this out. So back then, let's see where we were. That peak came on August 16th, the high, right? Let me pull this chart over here. What were we looking at back then? This was taken on August 18th. You can see right here, QQQ chart. So here's what we had. we had a primary larger uptrend line right there, which was my target, and then we had a smaller wedge. We actually had a very small wedge here. We had divergences just like then, divergence getting bigger, divergent I2, and that was our sell signal. Pointed out, we shorted there, nailed the high, wedge breakdown back test. Then we broke the secondary trend line. And so at that point, I don't know what the math, I can't measure here. This is a screenshot, so I can't do the measuring. But you can see from 335 down to 300, looking for a pullback to that trend line. And so I wanted to point out the similarities. That's the same, very similar. That was a 60-minute chart I just showed you to this setup here, where I'm looking for, we had the minor break, and we're looking for at least a pullback to that trend line, and then possibly, quite possibly more. As I said, we'll see if and when we get there. And of course, if we go back up, one thing, let me pull that chart back over and just show you one more thing I wanted to point out. So back here, you know, we had the small wedge right there. You can see the wedge break, and there was the sell signal. We broke down, back tested, started moving lower, but then we pushed up. We made a marginal new high. From in percentage terms, we're talking from about 326 maybe up to about 335. Not that much, couple percentage points. So I just wanted to say that if we happen to, if this sell signal doesn't take us down and hit that T3, and we push up and make a marginal new high, I'm talking just maybe a few percentage points, give or take 2, 3, 4, maybe 5%, keeps the divergences intact, then I'll be talking about the same thing when we get there. We are pushing, as I've been saying recently, the pretty much the upper limits of where I figured technically this bounce can go to and still fit the criteria of a bear market rally. Only hindsight's going to tell us for sure. So I just wanted to point that out, that you know, I don't favor that scenario, but I am certainly very much open to it. So that's what it looks like, and this is what it would look like on the 60 minutes. So we'd extend our divergence line out right there. We'd get a larger divergence right here. You can see the PPO is lagging, so it is an absolute certainty that if we popped up, what is that in percentage terms? If we did it, and we did it soon, to the tune of about another 2% or so, maybe 3%, that it would be a guaranteed, it would be a larger and still divergent high. So I can tell you, me personally, you know, the shorts I just stacked back on here the other day, and here, this is an objective short entry. I've got enough right now. I'm waiting to see when we get down here and then what to do, cover there, game the bounce. But if we went up there, I would sit tight. That's me. We're talking only from that point where we, you know, the initial short entry, we're talking 1 to maybe 2% at most. And if you take an average, if you short a lot here and short a lot there, split the difference, and you're still talking about 2, maybe 3% at most. So, and yeah, that's not a great RR for a 5% downside, but I do believe, as I've said many times over, there's very, very much the potential that this will morph into a longer term swing or trend trade, and you know, ultimately go on to take out this trend line, take out the trading range and all that. So that's it. That's what I see, and we may or may not get that other thrust up. If we get it, we could keep going higher, and that's where, you know, 3% or so, that's where you want to probably stop out, if not tighter. You know, there's nothing wrong with keeping stops very tight. So certainly a counter trend trade. Counter trend trades, as I mentioned earlier, have a higher rate of failure, but they pay off. The payoff is better than continuation trades normally. The RR is usually pretty good. All right, let's look at the big fangs real quick. Let me park this histogram, get that out of the way. We're done with that. Let's go to QQQQ. So I queue up my watch list. Why is it not loading? I need to do something here on the side of the screen. Okay, got it here. All right, I'm just going to walk you through the fangs. I did update as of June 5th. Here are the holdings in the Nasdaq 100. NVIDIA, since the last update I had just a couple months ago, NVIDIA leapfrogged both Tesla and Meta. So now Tesla's dropped out of the, you know, it's still a top holding, but it doesn't carry the weight. So these 1, 2, 3, 4, 5, 6 companies, Microsoft, Apple, Amazon, Alphabet, NVIDIA, and Meta, collectively account for 51.18% of the Nasdaq 100. Last time I did it, it was the same thing. It was 51 point something, right around there, almost exactly within a couple basis points, but except you had Tesla instead of Nvidia. So Nvidia with the little AI bubble hype has leapfrogged both Meta and Tesla market cap. But it's the same story for the Nasdaq 100. You have 6 stocks, as you did before, that literally comprise over half the returns of that 100 stock index. So it's kind of crazy. All right, this is the daily chart here, but let's look at the components. Apple. Okay, this is Apple, obviously an earnings juggernaut. We all know Apple's a great company fundamentally, but technically that's all we're talking about here. BEC, that's a bearish engulfing candle. That occurred on Monday, you can see right there. And bearish engulfing is when the body or the fat part of a candle engulfs the body, which in this case was a doji. There's a name for that one. I'm forgetting if that's there's a candlestick pattern. So that's a potential reversal pattern. So when you get the bearish engulfing candle, I always like to see follow through with at least one, ideally 2 red candles. So far, that's what we had. Obviously, if it is a topping stick, you can't take out the top or it's no longer a topping stick. So we had a little kickback rally today, but to be expected, the dip buyers are going to come in. They've been buying it. It's really been the algos, all the statistics, I'm reading saying that humans, retail investor, even hedge funds, they're not participating. It's mainly the algos, algorithmic trading, programs that have just been bidding up these stocks and keeping them going lately. Again, not absolute terms, but metaphorically speaking, the majority of those trades have been that. So anyways, we'll see if it pans out. Now, what Apple needs to do, you can see I have support about 176.15. So you really have this cluster here of candles, and there is a little gap right there as well. So here's the story of the Qs right now, is I'm seeing the potential for some island cluster tops. An island top is when you have after a long run, only look for it. Don't look for it anywhere in the middle of nowhere. You want to see a very extended run, and then you see a candlestick gap up towards the end of that run. There's a gap up candle. And then if you gap down, if that was the gap up candle and then you gap down the next day, that's an island top. An island cluster top is when you gap up and then you have a cluster, in this case right here, of candles. If it's separated by gaps on both sides, there's one gap. And if we were to gap down anytime soon, this week or next, there's the potential. And those are pretty reliable reversal patterns. And if it happened this way soon, you can see I have dual trend lines. I have a trend line right here in purple coming up right there, and a trend line off the lows. They both come in right together. And so that would be a pretty powerful sell signal, in my opinion, for Apple, especially if it came with a gap down to put in an island cluster top. Microsoft, you can see my trend line. This one is a bit forced. I had the trend lines on Apple were a little bit more clean. This one, because you don't have a lot of reactions, you have one violation there, and that's okay once in a while. I'm not crazy about it, but you had one candle and snap back. That was right around earnings, so that's where you get that kind of wonky move. A couple more reactions, so that's the best I can do. Like most other stocks, these big fangs, you have big negative divergences in place on Microsoft. And again, that's the best trend line I can give you. I'm not crazy about it, but looking pretty toppy to me. Alphabet. Okay, throughout the meta trade idea today, and in that comment section, somebody said they liked it or something. I said, okay, Meta's of the top holdings in the top 5, top 6 in the Nasdaq 100. I like that chart the best. My second 2 favorites, this would be one of them, Alphabet. You can see Alphabet has nice negative divergence right here. There's your divergence line right there on the price, higher highs. And you have this cluster of candles, and that was big support. So the story of the market here is we've had some breaks of support that have really charged the bulls up, and I got to acknowledge that. I need to acknowledge it. The S&P's taking out some key levels and in some of these key stocks. However, if they fail, a solid move back below that, roughly 122.60. You can call it 122. You can call it 120 if you want to be safe. But a solid move back down below there means that was a failed breakout. And I always say fewer things are more bearish in trading than a false or a failed breakout. A lot happens there. You clear out a lot of short interest on the breakout. You suck in a lot of new longs. and then so the shorts are gone, so there's no one to cover, no short covering on the way down to kind of buoy the pullbacks, and there's just nothing but stops that get hit. This is where all those that bought that breakout realize they're wrong, or should realize they're wrong. You could see a swift move back down, and it's a lot of thin air. There's very few trades that got us up there. So anywho, that's one level to watch in one stock, and one that if we start breaking down, that's also an attractive short. At minimum, and probably want to come and try to maybe backfill that gap, and more likely come in and come back, test at least the top of that trading range. That'd be a big drop, and it would do a lot to the charts from a longer term perspective if all these things happen. Bears, what they don't want to see is just power on through, burn through the divergences, hold on to that breakout after, right now it's just a breakout and a back test. That's all it is. And so there's the bullish case. The farther you get away from this level, the harder it is to make a bearish case. Divergences will be gone. But this is what I favor. And again, it's not an all-in moment, not even close, but it certainly gets to the point where I'd be increasing short exposure and probably extending those QQQ targets if and when we see those breakdowns below those levels on stocks like the breakdown on Apple that I just talked about, and Alphabet, of course, most certainly. Amazon, a little bit of a busy board, admittedly. I've got trend lines everywhere on this one. There's one potential that starts on that reaction high back in November of 2021, pretty much when the stock peaked. It put in a double top and divergent high, so you can draw that trend line there, and we're pretty much right on it. You zoom in a little tighter, what I'll note here is you have the negative divergence on both the RSI and the PPO, with prices making these higher highs, and then you have this trend line. So I would encourage you to watch these market leaders. This is all that the rally, this is the fact that these the Qs and these tech, AI related, just big tech stocks have been doing almost the entire heavy lifting in the market. They're helping to support the SPY and the equal weighted indexes and small, because they've all gone nowhere for months now, many months. It's all been about these big stocks, and so if they start to crumble, one of two things can happen. You could see smaller, those other indexes and smaller stocks play a game of catch up. That would be obviously the more healthy of the two. Or you can see those just also go down with big tech if big tech starts getting sold. So the level I would watch is this. This is a pretty clean up trend line. You have a lot of reactions. I'm not going to count them all, but you can see probably 10 or so distinct candlestick. So that's the minor trend line, and this is the secondary or larger uptrend line. So a break on Amazon there would bring us down there. And again, the scope of these big divergences tell me that very well we could be looking at the next leg down, a drop that will exceed 25 and maybe even 30% in most of these big stocks and the index, of course. NVIDIA, look at that. The king of the AI hype right now. And it popped up, and it's setting up in a nice island cluster right there. So again, one of the most beautiful things that those that are currently short could want to see right now would be a gap down tomorrow or Monday, sometime soon. The bigger the better on these stocks that do have these island cluster tops right there. So right now, NVIDIA, the bullish case would just say that it's digesting the recent gains, very overbought, nothing goes up forever. Last time that stock was here, I'll turn off all the lines here, and I'll draw one line for you and show you right here on the RSI, relative strength indicator, which is one of my favorites to determine how overbought or oversold a stock is. You take that line across there. The last time this stock was overbought was right here. It did have a little more upside. I'm trying to make that line as straight as possible, close enough. So we went up for about a week and a half, and then the stock fell from there, fell about 70, that's 68.65, so we'll call that 70% right there. And just something to note, rarely does the stock get that. And here's another comparable level right here. Again, I drew that line in. That was a comparable overbought level. So the stock is overbought. And so the way you look at it, the risk reward is not favorable to be long, it'd be more favorable short. It means It doesn't mean the stock must go down or can't go up. It's just saying at best case, the stock probably has a little more work to do to work off these overbought conditions. And technically, you know what it needs to do. And so look out for that. Set a price alert or just keep an eye on this one. So I won't go through each and every one of them, but it's the same story. The divergences, Tesla. I just covered the top 6, and now Tesla's number 7. So you can see what I'm looking at there. And so that's it. The only other thing I would add is the same thing I said before I left for the last trip down to the Keys last week before I left, is that if the Qs do hold up, the market holds up, then what you're starting to see is what I call a dash for trash. And so what I was focused on last week is said just small caps. And look at the bottom tier of QQQ. I just went through the top holdings, but when you flip it around and you go to the bottom holdings, those are the ones that if the market continues to hold up, I'm starting to see this now, traders are moving in for that dash or trash. They're looking, nobody wants to buy NVIDIA anymore. It's stopped going up because it's gone up so much, and Apple and Amazon. The upside, in my opinion, is very limited. So people are looking for these beat down stocks. If you're trading at it or near a 52-week or multi-year low, obviously the fundamentals are shit. Let's not kid ourselves. This is why a stock like Lucid's down here. But this is in the bottom of the Nasdaq 100. You have positive divergences. And just like that, what was it? That Beyond Meat set up today, that one ripped. Breakout. And traders are looking out and they're hunting out for these right now because it's a risk-on environment. After weeks of the Nasdaq going up, you get those armchair investors, the Reddit crowd and all that, and that's what they're gonna sniff out and try to find. So I'll just go through those bottom holdings one more time. Rivian already broke out, back tested. I covered these before I left town. Before takes out 1586. It should run quickly up to 20, almost 21. That'd be about a 35% pop, and possibly all the way up there to 28, and that'd be about a 78% run. Siri already broke out. I highlighted this one too. It's already up now 10%, and it broke out of the downtrend line. And again, these are where you have more bang for your buck. Apple hasn't gone up 10% in the last week. This one has. And you can see, of course, what Beyond Meat did today. Zoom, ready to take out that trend line and run. But be careful, because I view it, I've been here in this stage, that is typical late bull market or bull trend, whether it's a bear market rally, which I believe this is, or a late stage bull market action. You tend to get that dash or trash at the end there when people are just going out looking for things with the highest beta, the most bang for your buck. And it's a great game to play. There's nothing wrong with it, but it's like a game of musical chairs. You don't want to be holding the bag and holding these stocks when the music stops, because they will fall just as fast as they went up. But so if you're looking for trade ideas and you're not very risk adverse, you're willing to take a little risk, these are the names you look at. These bottom tier, that one already broke out, ZS Scalar, and you can go down the line. So, all right, I'm gonna wrap it up here. I'm just clicking on names and coming off divergent lows, and let's see what the Qs do tomorrow. Like I said, I like it better today at this R1 that we closed at than the earlier level. So this is where, quote unquote, the sellers should step in. And if they don't, like I said, and you pop that, then your next stand is right there. My guess, if they pop that and run at those previous highs, they're probably going to take it out. It's just from my experience, and clear the stops. This is what the games that the market makers play, and the algos and all that. So we either fall here. Again, I'm speaking in most likely scenarios. Fall here tomorrow and into next week, or we'll run up, clear out the stops, put in that larger divergent high, and then same targets, same levels. All right, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.